Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, May 12th, 2017. I had a request in the trading room for an update on IWM. I haven't posted a lot of commentary on IWM. Recently been focusing more on the large caps. That's what's been holding the market up, particularly the QQQ, and of that, particularly just a handful of stocks, as I've mentioned. So I did want to spend just a little time here, a quick overview on IWM. And we'll start out with a weekly time frame, work our way in, and then maybe touch, if there's a few minutes left, touch on the other major U.S. stock indices. All right, so this is IWM on a 10-year weekly chart. If I don't mention it, the time frame is right up here in the upper left-hand corner. You can see back in 2009 all the way up to 2011 we had a wedge and then a nice breakdown, and I believe that was technically speaking, a bear market, a drop, well over the bear market threshold of 20%. That was about a 31% drop in IWM back then. So, IWM's had its series of bull and bear markets within, you could call those cyclical bull and bear markets within a secular bull market, if you will, off 2009 lows. And we had another drop here, and I think that one was 28%. So there's been, two very profitable downside trends to trade, and quite a few profitable upside trends, throughout the bull market in IWM. And here's where we're at now. Bottom line is that back then we had this rising wedge, we had negative divergence, and here we have a rising wedge, negative divergence, and this will most likely kick off the next drop of 20 to 30+%, and that still appears imminent to me. Let's zoom down to the daily chart. Now, the story in IWM has been one of, we'll call it frustration. I've made mention several times. I have a short on IWM via the TF, which are the E-mini futures. And goodness, I've had that on what seems like forever. Most of the time it's been profitable, but a few times it's been underwater. Went underwater here briefly, profitable. Went underwater again recently as we come back to the top of this range. So the story in IWM, as I've pointed out, the small caps, and remember the IWM is just the Russell 2000 tracking ETF, so it's the small cap stocks. We're talking a trading range remarkable. It's not that it's unseen, it's rare, but that's 5.3 months. If you look at the pop-up box on the left-hand side, so well over 5 months, IWM has gone literally nowhere. You can see where it was back in, early December, and we're still trading, right now in the middle of that range. Negative divergence, I pointed out back here, we had a divergent high, and that's one reason I had, put on the TF short up here at that previous high. And it started to play out. I expected a downside break of this range. We had a little whipsaw signal. We went back to the top of the range. And I'll get to the 60-minute charts in a second, show you we've had two false breakouts. But what I wanted to highlight here, a couple things, and I've mentioned this before. The story is the same. It's wash, rinse, repeat in trading. Don't try to make it too complicated. As you see this chart, you see the annotations I have. Forget about all the horizontal lines for a minute. Just focus on the divergent highs. So we've had these divergent highs, and I hear people talk about this resilient bull market that you shouldn't short. Well, this one here led to a 28% correction, and I think that was, let me see, that might have just been from that point. That's 22. From this point here, it was 28%. Let me use my measuring tool. Yeah, that was a 28% drop from this divergent high. Now within there, and this is trading, I like to, for swing trading, use the 60-minute to daily charts and identify divergent lows and highs. So you can see here we had a divergent high. At this point we had a correction that it ended here with this divergent low, and that was a signal to get out of your shorts and get long. So we had a rally, divergent high, correction, and again this 28% really, this was a counter trend rally within a larger correction following this divergent high. Then you had a nice uptrend after this divergent low right here. You had a divergent high at this point, correction, divergent high, correction. We had a divergent high here. We did have a correction. If I recall, that was about a 6% drop from the top of that channel to the bottom. And most recently, we have another divergent high here. I'll move that over there. I'll show you that in the 60-minute chart, but you can see it right here. You can see the RSI is clearly making a lower high from these previous highs back here, as is the PPO, the MACD, just about everything else. So, you know, I still have, and I'll continue to reiterate this, a very high degree of confidence that a significant correction is coming. And just because it hasn't come, you know, I see frustration from a lot of people in the trading room. You know, you can look at this glass half empty or glass half full. You know, some frustration for people who've shorted this market says, well, this market refuses to go down. That's so bullish. You can look at it the other way too. It refuses to go up. And I'll make that point. You know, some people are going to talk about the Qs making new all-time highs. I'm going to go over the market real quick at the end of this video. So that's that. That's what I see. We need to break down below the bottom of this channel. It's around 133.45. Sure, we had that intraday or one-day pop below and snap back up, but you can see how many reactions, how well defined that bottom of that channel is. So you can disregard one little spike when you have numerous, probably a dozen or so reactions on top of that channel, as well as a reaction from below. So there's your key level to watch, give or take, you know, 133.45, especially daily close. And I have a high degree of confidence that we're coming down to at least the 125.66 area, at least, when these divergences play out. Now let's take a look at something here. I have that box right here highlights the trading range. Let's flip out to a 2-day period chart. One limitation with this charting program, it's very easy to use to navigate, especially when doing videos. But one of the biggest limitations to TC2000 is you can only go back 2 years on a daily chart. So what I've done is just flipped over to a 2-day period, meaning every candle's 2 days, and that gives me 4 years of price history. Now what I'm going to show you is something what I think is interesting. Grab this box, remember the trading range that I highlighted here, and look at this trading range right here. That fits nearly perfect. We had the same thing. We had a little fake out, blow off top, bull trap, we'll call it, a false breakout. When you break out of resistance, because that level, the top of that range was well defined, failed. We fell back in the channel, rallied back up, tested the back of the top of the channel once more, and that preceded that 28% correction. So I see no reason why this time is any different. I see a market that refuses to go up. Bulls see a market that refuses to go down. And I'm going to speak on that again about what the market is, not QQQ, not 5 stocks, the FANG stocks, Apple, Facebook, Amazon, Microsoft, and Alphabet. So there it is. That's what I'm looking at. We'll zoom out to 3-day chart. You can see it a little more clear. And let me give you a clearer board here too as well. Okay, this is the same thing. 3-day period. So we're just going back 6 years now. That's all. So each candlestick is 3 days. So again, here's that trading range that we've been in recently. And actually, let's tighten it up to exclude that false breakout. There's that top right there. And this, you know, the box, the distance of the box or the length of the box denotes the amount of time. So far, we've now mirrored this trading range both in scope from highs to low, as well as duration, the length, because this box fits on there perfectly. So does that mean we have to break out just because that's how long this one went? No, but rarely. And here's, 6 years of trading history. Do you see a range this tight that lasted this long? No, there have been some pretty large sideways ranges, but none have been so tight, such as this one. Oh, grabbed the wrong box. Other than this one right here. And again, that marked the top. And you can see the similarities too. If you look here, you have an uptrend, pretty well-defined uptrend line. You have negative divergence right here, leading into those highs at this point. Let's draw it out for you. I'll use the... I'll just circle it. We had a divergent high here. You can see the divergence confirmed, negative divergence. You had a divergent high at this point right there, breakdown back test, and we have a divergent high here. You can see the negative divergence down below. So again, it's, nothing is guaranteed in trading. I can't guarantee you this market, the IWM is going to drop 10, 20, 30% or more, but I would put a very, very high probability or good chance on it. And that's what technical analysis is all about, guys. Just looking at past price patterns, identifying and looking at what's happened in the past and trying to project what will happen in the future. And so That's how I see it. All right, let's go down to a 60-minute chart. Let's get off that, put that back to a 1-day. Clear out the annotations, 1-day daily chart, just so I can leave that there. Go back to my other board, and now this is what's going on in the 60-minute. I'll have to even zoom out to a 2-hour just to get a little more time. So here's that same trading range, as I said. Painful, frustration, whether you're long or short, bull or bear, you haven't made. I mean, you can trade the top and the bottom of the range, and if you're trading something like TF that's leveraged, or even TNA, TZA, those 3-time leverage ETFs, you can do well trading. Easier said than done. It's tough when you're in a sideways trading range. One reason is the indicators and oscillators. You can't really go off the 60-minute charts. You really need to try to trade off the 15-minute charts. But what I see when I look at this, again, I shaded the trading range here, and other than that shaded area, we've had just 2 instances of false breakouts, and to me this is bullish. You have such a large trading range, which is think of a trading range as a coiled spring. Prices are just building energy for the the break in the next direction. The bulls have had 2, not 1, but 2 opportunities to take this thing and run, and they failed on both attempts. So this, to me, it's tap, tap, tap. You're tapping on the top of this range. You've had 2 opportunities to take, or the bulls have, to take the reins and run, and they failed. Both breakouts failed. This one went down, came back up, like that one I showed you back a couple years ago, back tested the top of the range and fell to the bottom. We had another breakout recently. We've been bouncing around the top of the range. You can sort of look at the midpoint here. As I'm doing this video, I can just see one of these resistance lines right about here, support resistance level. You can see this is what we've been dancing on most recently. There's even a gap right there, so maybe we need to lose that gap support with conviction. If so, that brings us to the bottom of the range. And again, the longer this thing goes on, the more powerful the ensuing move when it breaks one way or another. And the only reason that I maintain that bearish bias that I'm expecting to downside resolution is this. I don't take breakouts. This market or the small caps can go up 20-30% if they want. Obviously, I'm not going to ride my TF position short that long. But it's these negative divergences that tell me much more than likely the next major break or move out of this range will be to the downside. All right, so that's that. Let's see what else I want to cover. We're only 12 minutes into this video. Just jumping back to the daily chart, someone had mentioned I was looking for confirmation of this divergence. And again, in my book, just what I refer to is negative divergence. I have both potential and confirmed. Potential is when you have I'll use an indicator with, a signal line like the PPO or MACD. If the lines are moving higher, as well as the RSI, if the RSI is pointing higher and it's still lower below the previous peak and prices are making a higher high, that's potential divergence. However, once we have that bearish crossover, then you have effectively put in a lower high. I'm referring to this high, this peak, because now we've turned back down. We made a bearish crossover just like we did here that confirmed that divergence, and I'm referring to this high. So you had this first high. Prices were back here at the time. Prices made a higher high at this point with a lower high, negative divergence. We had a 6% drop. Now, this is just an extension. I don't view this as a separate divergence. This is one much more larger divergence, twice as big as this previous divergence. Therefore, I expect the ensuing move to be much larger than a 6% drop. That's my take. There it is. It's confirmed confirmed on the daily time frame. And now let's just do a very quick wrap up looking at the broad market. And when I say the broad market, here's what we're going to talk about real quick. What's the market and what's not the market. Okay, let's start with what makes the bulls foam at the mouth. What makes people that think this market's going up another 20-30%, that this is some new great bull market and we've just broken out the new highs and we're going to much higher because we've broken out to new highs. The stock market, let me be very clear, the US stock market has not broken out to new highs. QQQ has broken out to new highs, which is the NDX NASDAQ 100 tracking ETF. I often say QQQ is simply a tech ETF with an Amazon kicker. I've said it many times. What I mean by that, this is the only index, U.S. index, and it's not a diversified index. All right, let me prove that point. I've done this before. This is straight off QQQ's website. Invesco is the company. Power Shares by Invesco. They run QQQ, and as I've mentioned before, the Q is almost 60% technology stocks. The next weighting is consumer discretionary. You notice you don't see financial stocks. There's only 1, 2, 3, 4, 5, 6 sectors in QQQ, and that's mostly tech. And of that, if we scroll down just a little bit more, you look at the holdings, and you can see that over half of the entire returns off the Qs are made up just of a handful of stocks. And I refer to these as the FAANG stocks, FAAMG, and that is Facebook, Amazon, Apple, Microsoft, and Alphabet, which are the Googles, GOG and GOGL. So that's what's held the market up. That's technology. Again, Amazon used to be considered a tech stock. It's really more of a retail stock. We all know that, even though it's online presence. So that's why I call it the Q is a tech fund. In fact, look at the top 10 holdings. You can see not only they're very unbalanced. Other than Amazon, the only non-tech company is Amgen in there. Every other company, Cisco, Intel, I should say Comcast. That's they do a lot of digital media, but obviously, it's a cable company. But you get my point. You can add this up and just see. And again, it was evidenced up there. So that's not the U.S. stock market. That is not representative of the overall economy. You go to something like the S&P 500. We all know that's much more diversified, representative. It's not so top heavy. Apple is the biggest component in the S&P 500, but not by a very wide margin. A much smaller margin than it is in the QQQs. This is the Russell 2000. Here's the small caps. As you can see, you have financials. You have tech, but it's only about 18%, not 60%. Industrials, healthcare, consumer discretionary, down the line, a lot more sectors. So now to wrap up my point. So there's Qs. This is where everyone's saying the market's broken out to new highs. I don't see it, guys. I don't see it. Let's look at this. S&P 500, top back here, March 1st. We're struggling with those highs. We basically made a double top, and we failed to break out to new highs. I mean, we're talking maybe a couple basis points, but that's roughly an equal high. Very steep divergences. Even if we punch up, and I made this mention before, but we even took out the recent highs. When we're down here, I said it's almost certain we're going to see a breakout. When you get that close, it's like a magnet. Prices are going to try to make a run at those highs, but so far we've failed. We popped just slightly above it. Again, I'm talking a mere fraction of percent. So essentially a double top high. And even if we have another thrust up, no matter what, we're going to put in very strong divergences. And again, I'd rather be wrong than discard the rules of trading that I've used forever. I don't take breakouts with strong negative divergence because 9 out of 10, if not closer to 10 out of 10, they fail. And this has strong negative divergence here. You can see it right now. It's in fact, it's almost confirmed. It is confirmed now. We had that bearish crossover. You can see these lines crossing over actually really close. We're right there. Any more downside in the SPY, and we'll have confirmed divergence. We just put in a slightly higher, roughly equal high. So there it is. There's what most people consider the most representative index of the U.S. stock market. Wilshire 5000 is even more diversified. 5,000 companies. Here it is. Negative divergence. Same thing as the SPY. Roughly equal high. Very steep negative divergence down here. In fact, double divergence. We had a divergent high here. A little correction. Pushed back up. Made another high. And all we've done is extend that divergence. So again, this is a much more representative index of the total U.S. stock market, the U.S. economy, than is QQQ, which is, again, tech fund with an Amazon kicker. So you need more evidence. Here's the mid-cap stocks, MDY. Mid-caps just slightly under that previous high, so they haven't broken out like everything else. The U.S. stock market topped back on March 1st and is yet to break out. Very steep divergences. So even if the mid-caps make another thrust up here, they would have to move up. They would have to move up enough to take this RSI up and above that previous reaction high, as well as a PPO. And I think there's a snowflake's chance in hell that's going to happen, guys. That's just the way I see it. Right or wrong, I'll tell you what I see and how I trade. And there's IWM again, just eked out a marginal new high, very slightly higher high. Like I said, I showed you on the 60-minute chart, it failed. And that high was yet another divergent high and a more powerful one. That's it. I don't know what else to say. Been saying the same thing for a while, and I do this because I was asked for an update on IWM. Still very, very much, expecting a big move down. And again, there's my minimum downside target right now. I think it's going down to around this 125.66 area. And as always, I'll take the charts as they come. You can only look out so far ahead. I equate technical analysis a lot to like weather forecasting. A weatherman can tell you with a pretty good degree of accuracy, is it going to rain today, tomorrow, next week? But looking out a month, 2, 3 months from now, that gets a little harder. So as I always say, the charts are dynamic, not static. They change all the time. And, as things go on here, if we break to the upside, if these divergences start to burn out, if I see some other type of bullish price action or anything in the market that convinces me otherwise, I don't have to immediately flip to a bullish case. I could, bullish bias, I should say, but I could at least go to a neutral bias. But right now, I'm not. I remain net short. Taking fewer and fewer longs, even booked profits the other day on that QCOM hedge that I had on the against the semis. I took that out a couple days ago. Fortunately, so far so good. I was on Wednesday, I believe. And I'm winding down a lot of longs. First Solar, some of the other ones that I've had were official. Took that out, and that one's held up. That's about right where it was when I closed it out early the other day, a week or so ago. That's it, guys. I'll wrap it up here. 21 minutes. It's not too bad. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoy it.